Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's top story with you. We're starting off the week with a look at China's economic growth, which has been a topic of interest for investors around the world. According to recent data, China's GDP growth slowed to 4.8% in the third quarter, which is in line with forecasts. This marks the weakest pace in a year, and it's largely due to a prolonged property slump and trade tensions that have hurt demand. Now, let's take a closer look at the numbers. The 4.8% growth rate is down from 5.2% in the previous quarter, and it's a sign that China's economy is facing some challenges. Fixed asset investment, which includes real estate, expanded by only 0.1% in the first 9 months of the year, according to analyst estimates. Retail sales slowed to 3% year-on-year in September, while industrial production eased to 5%. Despite these challenges, China's exports have shown resilience in the face of trade tensions with the U.S. In fact, official data released for September showed that exports continued to grow, which is a positive sign for the economy. It's also worth noting that China's government has been taking steps to stabilize the economy and promote growth. The Ministry of Finance recently announced that it will allow provinces to tap into unused bond quotas to beef up fiscal health, which could help support infrastructure investment in the fourth quarter. As we look ahead, all eyes are on China's 15th five-year plan, which is expected to be approved and released in March. The plan is likely to include policies aimed at rebalancing the economy towards domestic consumption, which could have significant implications for trade and economic growth. We'll be keeping a close eye on these developments and bringing you updates as more information becomes available. For now, it's clear that China's economic growth is slowing, but the government is taking steps to support the economy and promote stability. That's all for this segment of the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and risk management. In this segment, we're going to explore some interesting developments in the Indian financial sector. Let's start with Punjab National Bank, which has reported a significant increase in net profit for the second quarter. The bank's profit rose by 22% year-on-year, driven by a decline in provisions for bad loans and an improvement in non-interest income. This is a positive sign for the banking sector, which has been facing challenges in recent times. Moving on to life insurance companies, they have already undergone a phase of re-rating after 3 years of underperformance. According to Digant Haria, a market expert, the sector's growth is still lagging behind expectations, and it may not see secular growth of 15.6% as previously thought. Instead, it may provide market-linked returns from now on. In other news, Reliance Industries' performance has been steady across segments, but its size limits its growth potential. The company's traditional businesses, such as oil refining, are not doing badly, but they're not doing great either. Additionally, the fast-growing divisions, Geo and Retail, have already seen significant stake sales, which may limit their upside. Lastly, HDFC Bank is emerging as a value play, with valuation gaps between it and other large private banks presenting selective opportunities. However, the bank's growth catch-up will take time, and it may need a few more quarters to regain its stride. It's essential to remember that the Indian financial sector is broadly stable but uneven in momentum. Investors should be patient and selective in their positioning to navigate the next phase of India's market cycle. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. As we wrap up today's show, I'd like to bring your attention to a developing story that highlights the complex and increasingly tense relationship between Australia, China, and the United States. In recent news, Australia has accused China of conducting unsafe and unprofessional military jet maneuvers over the South China Sea. According to reports, A Chinese Su-35 fighter jet released flares in close proximity to an Australian P-8A patrol aircraft on Sunday, prompting concerns about the safety of Australian personnel and the potential for escalation. This incident is just the latest in a series of encounters between the two countries' militaries in the region. Australia has been critical of China's expansive claims over islands and outcrops in the South China Sea, which overlap with those of its neighbors. Meanwhile, China has accused Australia of intentionally intruding into its airspace and responding in a lawful and restrained manner. It's worth noting that Australian Prime Minister Anthony Albanese is currently in the United States for a meeting with President Donald Trump, where they are expected to discuss the AUKUS submarine deal between Australia, the US, and the UK. This deal has been seen as a significant development in the region's security landscape, with implications for China's growing military presence. As investors, it's essential to stay informed about these geopolitical developments and their potential impact on global markets. The South China Sea is a critical trade route, and any escalation of tensions could have far-reaching consequences for international commerce and economic stability. In conclusion, the situation between Australia, China, and the US remains complex and multifaceted. While we cannot predict the outcome of these events, it's crucial to remain vigilant and adapt our investment strategies accordingly. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.